Franchise Secrets, Erik Von Horn.
If you're not a part of the Franchise Secrets Facebook group, what are you waiting for? It's franchisesecrets.com/Facebook. I cannot believe how valuable this group turned out to be. When someone asks a question, the feedback is honest, authentic, very helpful, and it's from multiple perspectives. If you're not sure that you're getting the most accurate information about franchising, then check out the largest, most helpful Facebook group in all of franchising. Whether you're a Z, a Zor, a buyer, or investor, join our free Facebook group at franchisesecrets.com/Facebook. Wow, you are going to love this episode with Tom Wheelwright. Tom is a rich dad advisor, CEO of Wealth Ability. He's got some amazing books, bestsellers. His latest book is what we really get into. It's called The Win-Win Wealth Strategy. We had some laughs. We got into a little bit of tactics, a whole lot of strategy and mindset, ways for you to know if your CPA is a good one, a bad one, or maybe just okay. Talked about how to use your business as some of the major tax deferral, tax credit strategies. So business owners, you've got to listen to this. And I think this will just open up so many minds. I think you're going to really enjoy this episode with Tom Wheelwright. Well, Tom, I've been excited to get you on the moment that I knew that it might be a possibility to have you on as a guest. Whenever I get somebody like Robert Kiyosaki or Tom Wheelwright, I'm super excited about it. So thanks for taking some time.
Oh, thanks for having me. It's always good to be with you guys.
I just got done playing pickleball. I was telling you before we hit record, and people know that I don't work on Fridays. And one of the guys said, "What are you doing?" I'm like, "I got a podcast I'm recording with someone that's a big deal, Tom Wheelwright." He's like, "Oh, I love his stuff." And then he left me like a big long list of questions to ask. But
I love it.
Yeah. So you got a new book out. I think your book is like one that's perfect for my audience. It's The Win-Win Wealthy Strategy. Can you talk a little bit about the book for a bit about your background, and let's hop into it?
Yeah. So I've been a CPA for 40 plus years, and I've done it all. I've done Ernst & Young, their national office. I've got a master's of tax. I've been an adjunct professor in the master's of tax program at ASU. I've been a tax advisor for a Fortune 1000 company. I've built and bought and sold CPA firms. And as you know, spoken all over the world with Mr. Kiyosaki. Lately I've found that there's a challenge I've been running that we've all been hearing about. And that is this whole thing about tax the rich, right? That the rich don't pay tax and they're cheaters, or there's loopholes, and oh my heavens, this is terrible. We need to raise taxes on the rich. And I'm going, but wait a minute, that's not the way the tax law actually works. And I've literally worked with thousands of investors and business owners over the years. And I found that to be completely untrue. I'm also a little offended by it, because all rich people have CPAs. And so that means that either the CPA is complicit or stupid. Okay. And I don't believe CPAs are complicit or stupid. I think more likely what the case is that the tax law doesn't work the way people think it works. And so what I did was I decided somebody needs to write the book about how the tax law actually works, and why wealthy people don't pay tax. Why don't they pay tax? I mean, I'm not saying they do, because my clients are wealthy, they don't pay tax. So, I'm not disputing that they don't pay tax. I'm disputing that the reason they don't pay tax. A lot of people think, in fact, I'd say most people think that taxes are a zero-sum game. It means that either the government wins and you lose, or you win by cheating and the government loses. And that is so far from the truth. Now, the reality is the government's always going to win. Okay. But the reality also is that you're a partner with the government every one of us is a partner with the government, whether we like it or not. The first time we got a paycheck and we saw that pay stub and we saw the withholding, we saw the FICA, and we go, what the heck? How come I'm not getting all my money? All of a sudden it dawns, wait a minute, we're a partner with the government. I'm a partner with the government. The question is, are you going to be a silent, passive partner with the government, pay loads of taxes? Or are you going to be an active partner with the government, doing what the government wants done, serving more people, building more wealth while you're paying less tax? Those are your choices. But unless you get the education to know that you have that choice, your tendency is to be a victim and say, well, wait a minute, everybody, well, I'm a silent partner. Everybody must be a silent partner. No, that's not true, right? So you take, for example, a business owner, which is the first big chapter in my book. That's the first investment I look at. And around the world, okay, around the world, we looked at 15 different countries. We didn't just look at the US. And around the world, business is the biggest tax incentive. Owning a business is the biggest tax incentive in every single tax law in every single developed country. Okay. And what that means is well, go, well, why? Well, because the number one thing that the government wants to have are lots of good jobs. That's what they want. Business creates jobs. The fallacy, frankly, of a lot of the discussion in the media and politicians right now is they think workers create jobs. Workers do not create jobs. Workers fulfill jobs. It doesn't mean they're not important. It just means they don't create the jobs. Now, if the government really felt like workers were more important than business owners, then for the last 2.5 years, while we were staying home because of COVID, employees would have received a tax deduction for that home office and business owners would not, but it was not the case. Employees did not get a tax deduction, business owners did. Well, that should tell you right off the bat how the government feels about business owners versus employees. They're fine with employees. You want to pay more tax? Go for it. Okay. You want to pay less tax? You want to build more wealth? Read my book. I mean, it's actually that simple.
What I found is there's a lot of business owners, wealthy people, and then smart people with good CPAs. But then there's a whole nother level of like people that have access to family office type advisors, people like you, and people that don't, and people that have access to the ultra wealthy and their strategies, and they learn from them. They're able to implement some of that stuff. And Justin and I do that in the masterminds. Is that one of the reasons that you like this book? These are strategies that the average wealthy person may not fully understand.
Well, I would say the average rich person. So I'm going to distinguish between rich and wealthy here.
Teach me, coach me. I'm coachable.
Rich to me is somebody who makes a lot of money, and wealthy is somebody who owns a lot of assets. Okay. So, and I know you and Justin are big on, assets. Okay. And small on work. Cause I know Justin, he hardly works at all. So
we're cut from the same cloth. He and I are good buddies.
So it's not surprising to me that you came from the pickleball court, buddy. And I'm going, I just don't understand how I got you on a Friday, because I'm surprised I got you on a Friday, a Thursday, a Wednesday, or Tuesday. I thought you only worked Mondays. But that's the wealthy, right? The wealthy, they're building assets. And because one of the rules of the game is the more money you make, the more tax you pay. The more wealth you build, the less tax you pay. Okay. So what all the government's saying is, look, if you're building wealth by building a business, if you're building wealth by developing real estate, if you're building wealth by drilling for oil, or putting solar, doing solar farms or solar on your business, or you're building wealth by producing food and for the country, right? I mean, agriculture is a big one, or you're helping more people by developing technology. You do any of these things, basically what you're doing is you're serving a lot of people and doing a lot of good in the world, doing exactly what the government wants you to do. And as a result, the government says, well, we're going to be an active partner with you, and we're going to put money in we're going to put money into this deal. So the cool thing is it's just a set of rules, right? And it's a set of rules I went through in my first book, Tax Free Wealth. And it's just a set of rules that says, look, here's the game. Here's the rules of the game. Now, you have to play by the rules. I mean, I'm not a fan of cheaters. In fact, I fired clients who said they were going to cheat. I'm going, well, we're done right this minute. Okay. I do not work with cheaters. And I just think that's just lazy, right? People who cheat are just lazy. People who, yes, you're right. The wealthy have good tax advisors, which is why they pay less tax. It's not that they know more, it's that their tax advisors know more.
Yeah.
Well, the whole purpose of the win-win wealth strategy, 7 investments the government will pay you to make, is to let everybody have that information. To do it, $25, and this information is yours, right? I mean, Amazon, it's not that hard. And so I just want more people to understand that, building wealth is not about paying tax. Building wealth is about doing good.
I love that. So many of my wealthy friends are under your terms of wealthy, and I like it, are the biggest givers. Like they're in private giving clubs where they just give. And I've seen that side of it. So I love that. So here's the deal with the Franchise Tribe Mastermind. It's full of a bunch of successful franchisees across many different industries, many different brands, and you get to be a part of that. Now, if you've had any level of success in franchising, you've probably been around top performing Z's in your current brand. So think about that. And if you could do that with 40 plus different brands, industries, franchisees, that's the value in the mastermind. I bring in some of the best speakers in the world. We talk about some topics that will never be talked about anywhere else. So if you're interested in being a part of a group like that, check out franchisetribe.com. I want to understand the difference between an accountant, CPA, tax strategist, because there's a lot of people out there listening, and like, they might think they have somebody that's really good. That is the advisor that's helping them, but they might just be a tax preparer or an accountant. So can you kind of distinguish, like, how do you know you have somebody really good on your team?
It's really simple. They are constantly asking you great questions. Okay. They're always asking good questions, and they may even be reframing your questions. For example, a question I'll get all the time is, they'll look at their coffee mug and say, is this deductible? Can we change the question? Let's change the question to, how do I make this coffee mug deductible? That's a better question, right? Because if you ask me the question, is this deductible? My answer is, I have no idea. I don't. Now, you ask me how to make it deductible, I can tell you that in 3 minutes or less, right? So a good advisor, and not just a tax advisor, but any advisor, a good advisor will ask you better questions and will actually force you to ask better questions. So they're going to dig into that, find out. And also the other thing is you're going to meet with them on a regular basis, right? You're not going to meet with them once a year to go over your tax return. You're going to meet with them at a minimum quarterly. Hopefully, if you really want to be successful, you're going to meet with them monthly. And every time before you ever do any kind of financial transaction, you're going to involve them in that transaction, because it's much easier for me to help you before you do it than after you do it. And it's just a different relationship. It's a partnership. It's not do it for you, it's do it with you.
So I love that. I think, I love these different strategies, and sometimes there's like a litmus test. I wonder if people have heard about certain things and their CPA helps them with certain things. So, and I love reframing questions. So let's play a little game. Instead of, saying, is my house deductible, as a business owner, like, how many ways can I use my house to mitigate taxes? And one of the things I think about in the back of my head when I ask that, Tom, is the Augusta rule. And how many people know about the Augusta rule?
Sure.
And what do you think about that one?
Oh, well, it's, I love that a golf tournament created a rule like this. That comes from the Masters tournament. Is why it's called the Augusta rule. Basically, all it is there's a law in the tax code that says that if you rent your house out for 14 days or less during the year, you don't have to pick up the income as taxable income. Sweet. And the reason it's 14 days is because people would go to the Masters tournament, they'd go a week ahead, spend a week there, and they would, people around the golf course in Augusta, Georgia would just, leave. And they go, I'm going to leave and I can rent my house out for like $2,000 a day, but that's $24,000 of tax-free income. That's pretty sweet. Well, now, you can, let's say the Olympics are in there. Let's say I've got a place up in Park City. We have the Sundance Film Festival. It doesn't matter. You've got 14 days that you can rent out. You can even rent it to your own business, frankly, for that 14 days, and then not pay tax on the income.
So this is fascinating. So we asked about the question. I asked the question, how do you do that? And everyone starts thinking, I can rent this out to different people, strangers at different times. And then at the very end of this conversation, your smart advisor, smart CPA is going to come in and say, you can even do X, Y, and Z. And Tom just said, you can even rent it out to your business. So can you take a little deeper dive into that? How can someone rent it out to their business?
Yeah. I mean, let's say you've got that vacation home, right? I mean, this is typically where you've got a vacation. It's probably not your primary residence we're talking about. In this case, we're probably talking about a vacation home, but let's take the vacation home I'm building up in Park City, Utah. Okay. So it has 5 bedrooms, 5 suites, and a swimming pool. And so why not have a corporate retreat up there? Why not do it that way? I mean, you're probably going to do it at a house like that anyway. I mean, why would you really want to do it at a hotel? I mean, if you're a smaller business, right? Let's say you've only got, 4 or 5 of your key people, you're probably not going to do that at a hotel. You're probably going to go on Airbnb anyway. Why not use your own property for your Airbnb? Why would you use somebody else's? So it just has to be, of course you have to dot your I's, cross your T's. You got to have a contract. It's got to be a reasonable amount of rent. You use comparable numbers to what the other what the Airbnbs are for a similar property, and you're off and away. And here's the thing: in that case, your business is paying the expense, right? So your business is getting a deduction, but you're not picking up the income. So that's where you get a benefit both sides of that.
I like that. Your business is paying the expenses, but not picking up the income, and you get to benefit on both sides of that. That is win-win. I love that stuff. Tax effective investments. You talk about that in your book, The Win-Win Wealth Strategy. Talk to me, where do you want to go with tax effective investments?
Yeah, I coined that term because I've never heard it before. I think it's the better term. I hear financial planners all the time. They'll talk about tax efficient investments. So if we can distinguish for a second, a tax efficient investment is one where I don't pay tax on the investment. Right. So, or I pay capital gains tax instead of ordinary income tax. It would be a tax efficient investment. A tax effective investment, not only am I not paying tax on the income, I'm reducing my taxes on other income. So for example, let's say I've got a business or I've got a job, I'm paying taxes on that income ordinarily, right? Now, a tax effective investment, let's say I go invest in multifamily real estate as an example. Okay. And I get a deduction that is greater than my income from that investment. I get to use that deduction with good planning against the income that I earned in my job or my business. Well, when I do that, I now have lower taxable income from my job or my business, which means I pay less tax on my job or business income. That's tax effective investing. That means that you're actually getting the government's literally the government's is paying for part or all of your investment.
Dude, I love the government paying for part of all of my investment. Where do you find investments like that? Is that just is it mostly real estate? Are there
I literally go through 7 of those in my book, The Win-Win Wealth Strategy. So I literally describe 7 categories of investments that any one of them. I mean, the number one is business. Remember, every dollar that you earn in your business that you put back into your business is not taxable. So, and for most people, the best investment they will ever make will be their business for most people. And it'll be they'll have the highest return, they'll have the most control, and they'll pay the least amount of taxes, right? So that's why business is so important. That's the number one investment. It's like the number 1, 2, and 3 investment, because even if you look at real estate or agriculture, which are a couple of the other investments, they're still businesses. So you get both. So they just have additional benefits besides business. Okay. So really, when you look at these 7 investments, they're a bit cumulative. And when you really get good at it, like my clients are, when you really get good at it, you're using several of these investments at the same time. And as a result, you're paying very, very little tax, and you're building a lot of wealth. And here's the thing, you talked about the giving clubs and stuff like that. I'm not even talking about charity. I'm talking about, let's think about a Jeff Bezos or an Elon Musk. Okay. Here, probably the 2 most well-known entrepreneurs in the world right now. And here's 2 guys that they've developed technology and businesses that have literally changed the world and will continue to change the world. Can you imagine the last 2.5 years without Amazon? I mean, seriously, it would have been way worse than it was. Okay. So we're all grateful, and yet we're not, because we're vilifying Jeff Bezos for being rich and paying no tax. Well, but why didn't he pay tax? Well, because the government wanted him to develop Amazon. They wanted him to develop the technology, and they gave him tax incentives to do so. So really, again, anybody can do it. The reality is, you don't have to be a Jeff Bezos to do it. You don't have to be an Elon Musk to do it. Joe Smith off the street can do this. And the tax laws are the same for the little guys they are for the big guy. They're exactly the same. That's under our Constitution, they have to be. So it's the only thing that's not fair is that typically the little guys don't know these rules, and they don't have the advisors who know these rules. And that, like you said, the big guys have people like me that, study these rules, and we know these rules. That's why I write books, so that more people can know, and even can take them to their advisor and say, would you look at this? Okay. So I give an example. So take a retailer, take an Amazon retailer who has a whole bunch of inventory. Well, I would tell you that most retailers don't realize, small retailers don't realize that they could deduct their inventory when they buy it. They don't have to wait to deduct it when they sell it. Most of them don't know that. And in fact, that was a new law from 2017. I had a number of people challenge me on that, say, well, the IRS says you can't do that. I'm going, well, actually, finally, the IRS admits that you can do that. Okay. And they actually tell you how to do it in the regulations. So, this is just something of get educated, recognize that investing is a team sport, and, get good advisors. But if your advisor doesn't know, this is why we created a network of CPA firms. We have 60 CPA firms around the country, and I train them on a monthly basis. And the reason we did that is because I was just finding that people need the advisors, and they might have a tax advisor they really like, but their tax advisor doesn't know this stuff. And I just say, well, then send them to me. I'll train them. I'm happy to train. If you like your tax advisor, chances are I'll like your tax advisor. I don't let everybody in, because the number one rule is I have to like you you need to be an entrepreneur. In addition to being a tax advisor, you need to be an entrepreneur, and I have to like hanging around with you. And if I don't, you're out. So I'm not going to let you in.
We've been talking a lot about education in this last bit of this conversation, which I absolutely love. And I don't think what the average listener, at least I certainly didn't until I started to talk to more people like you, is you get so many people want to talk to you. So many people want access to you. So many people want access to me, not nearly as much as you and some of these others, but you start to create these products to help so many people, and you're not giving just little tidbits. People like you give a lot of gold in books and podcasts and things like that. So in addition to the book, like, where are you online and and podcasts? Where can people get into your world and find you?
So I do 2 podcasts. One's the Wealth Ability Show, and the other is specifically for CPAs. It's the Wealth Ability Show for CPAs. And then I have a YouTube channel, and then I'm in all the social media. So Instagram, Instagram's a big one right now that we're focused on. Certainly, Facebook and other social media, but really the best place to go, I think. I love doing podcasts, as you can tell here, but I love being the student, right? It's fun being the teacher. That's fine. But I love being the student.
Yep. And
so I learned so much from doing podcasts. So I think that's a great one, particularly the YouTube, because on YouTube, we actually get the video of it. Right. So I'm a huge YouTube fan. I just think, let's get more than just listening. Let's actually, watch them, see them interact, see what's going on. And then, you decide you need a better CPA, just go to wealthability.com and we'll hook you up.
So how do people do that? So it's kind of funny. People with their CPAs, they feel bad about leaving them.
Mm-hmm.
And yet they are thinking, I've outgrown them, or they're not as good as I thought. So, and I hear this all the time from people. So like, how would someone that says, I just don't know that I fully trust that my CPA is at the level that I need them to be, how would they go reach out to you or somebody else? Like, what's the right way to do that?
So here's what we do. You go to wealthability.com and you say, I want to, I want to have a conversation. There's a button right up top, right? And so you schedule a consultation. And what we'll do is we actually developed a software program to help us actually know whether we think we could save you taxes. So we run your numbers through this software program. It's a pretty simple program, but we run the numbers through, and so we do an evaluation based on prior year tax returns and say, look, are there ways that you could be reducing your taxes? Yeah, there probably are, or there aren't. And if there aren't, then and what you really want is just a better CPA, we're happy to do that for you too. But a lot of people just want to know is, like you say, they just like a second opinion, and we're happy to do that. We don't charge for that. We're happy to give you a second opinion, just kind of run you through our calculator and say, okay, are you paying too much tax? And then you can know. The other side of it is, like I said, if you really like your CPA and you go, I think my CPA would be willing to learn this, then have your CPA, then set up an appointment for your CPA to meet with us at Wealthability, and we'll see if they're a good fit for our network, and we'll bring them in the network. We'll train them.
I love that. I work with Do Wealth, Jim Do. You might know
I know Jim Do.
Mm-hmm. And so I'm one of his clients. And if I have somebody that's good on my team, like a good, advisor, they vet them out. And sometimes they're like, this one's not that strong. This one's really strong. I want to work with them. And it sounds like that's how you are with CPAs. If there's some good CPAs, like, let's spread the wealth out there.
Yeah. Oh, for sure. And we just have so many people asking us for, somebody who knows what I know, and that they can work with, because I don't work with very many clients and I'm really, really expensive. So what we do is we train them. I'm literally training our CPAs at least monthly, and sometimes multiple times during the month. We have a whole software program that we run people through to make sure that the CPA is doing their job, and make sure that they're doing things the way we'd want them to do, and that they've got a system for reducing taxes. So I think you really want to make sure that, I think you're right. I think your CPA, if you really look at why the wealthy pay less tax, for the most part, it's because they have better advisors.
Mm-hmm. Attention franchisors, if you are not bringing in many of the right franchisees, sales are slow, it's stealing too much of your time as a founder trying to award franchises to the right franchisee, there's a better way to do it. That's why I started the Franchise Sales Mentor. If you want to have access to the information, the techniques, the ways that the best franchise sales organizations are awarding franchisees, then you might want to check out the Franchise Sales Mentor. The reasons that franchisors join is because they want access. They want access to my Rolodex. They want access to my connections. They want access to shortcut both short-term and long-term success to increase enterprise value to their brand. It's pretty simple. One of the things that I've noticed as I interview people that are coming into the Tribe of Investor Mastermind, they're always focused on the return. If I put in $100,000 or $200,000, I can see the different returns that you've been getting are between, let's say average of 15% with some equity in a company and some preferred returns. And so they're looking, I need to put in X amount to get my $20,000 feedback. That's the tuition, that's the admission to get into our mastermind. But then once they're in, they're like, holy cow, I've saved so much by having really smart people like you, Tom, come in there and talk about stuff. And then, after that, they're like, oh my gosh, I was setting up my investments wrong. I was investing the wrong way, the wrong vehicles. I was doing everything wrong. And I thought I would needed to return on my money, but I could just save a ton of money. And it's really eye-opening. So I love this discussion.
Yeah. The reality is the fastest way to make money and to put money in your pocket is to reduce your taxes. It's by far the fastest. Typical entrepreneur comes to us, and this isn't always the case, but typically we're not going to take them on if we don't think we can reduce their taxes by 10 to 40% within 3 months. And
Say that again. I want
not guaranteed. Okay.
No, but I want that to sink in.
Okay.
I want that to sink in though, because people might have the mindset of like, oh, just a little bit here, a little bit there, but there are a lot of people are missing out on massive amounts of money.
Oh, massive. Look at what the total tax was on your tax return. Okay. Multiply by 20%, and you're probably leaving that much on the table. Probably. Okay. You probably are. Typically, 10 to 40%. We've had clients that went from $1 million to 0 in a year. So, that's not typical. Again, not typical. At the same time, is it doable? Absolutely. What our job is to give, and my job is to give people a choice, right? Because unless we understand this, unless we get the education, unless we have the advisors who are educating us, well, by the way, that's one other thing an advisor needs to do is educate you. If your advisor isn't educating you, get a new advisor today. Okay. Because your advisor's primary job is to educate you, because I can't reduce your taxes, but I can tell you how to reduce. I can tell you what you need to do to reduce your taxes, but I can't reduce your taxes. Okay. Except when I'm doing your tax return, I can a little bit. But really that's your job, is to reduce taxes. My job is to tell you how. So, you get these advisors, you get a good advisor who can educate you. All of a sudden, reducing taxes by 10, 20, 30, 40%. Sorry. I've literally done it on stage before. I've pulled somebody out of the audience on stage. I remember the first time I did it. It's pretty fun. Because
that's a little risk to take too.
It's a huge risk, because I don't interview them ahead of time, right? These are random people I'm pulling up on stage. And I can do it in about 5 minutes. Typically it takes 3 months. But could you do it in 5 minutes? Yeah, you could. If I understand, because I can ask the right questions, I know what questions to ask, and I know what answers to give pretty quick.
The stock market. I talk to a lot of these people that are business owners. They have excess cash. They're thinking about buying another business or doing this. And I start to look at their financial situations, and they're heavily invested in the stock market. The majority of their investment is the public stock market. What do you see from wealthy people?
That's for a lot of people don't build wealth in the stock market typically. Okay. People maintain wealth in the stock market. Okay. So remember the whole idea of the stock market is to diversify your portfolio, right? I mean, there's an actual mathematical formula for that. And the whole goal of diversification is to not lose money. It's not to make money. It's to not lose or lose less money. Okay. Now we've seen the stock market come way down this year. So everybody in the stock market lost this year. I mean, nobody was really making money unless they were professional traders, and then they made a bunch of money. But seriously, they did. You make way more money in a bear market than you do in a bull market if you know how to trade stocks, technical stocks trading. But the challenge I have with the stock market is I find the stock market very risky because I don't have control over it. Okay. I have control over my business. I have control over, I have an office building. I have control over that office building. I have control over making sure that it's well maintained. I have control over the rent. I have control over the people, the renters I put in there. I have control over, where it was when I bought it, right? I don't have control over Apple. I don't have control over Tesla. I don't have control over Elon Musk. I don't know when Elon Musk is going to go.
Nobody does.
And then do a Twitter, right? I mean, so I'm not, that's not me. We focus primarily on all the other investments. Now, there is a way to invest in the stock market that's a win-win strategy. And that is through government pension plans. Okay. That's like a pension plan, a profit sharing plan, a SEP, an IRA, 401k, those kinds of things. For an average person who wants to invest in the stock market, they do work. Now, you're not going to be wealthy as a result. Okay. So that's the thing. Are you building wealth or are you maintaining wealth? If you're building wealth, stock market's unless you're going to learn how to trade, stock market is probably not the way you're going to do it. Certainly buy, hold, and pray is probably not the best way to build your wealth. And certainly diversification is a horrible way to build wealth. It simply does not work. So we always say, my preferred saying is a niche will get you rich, right? And so when we actually talk to a new client, we take them through their wealth strategy first, right? So the win-win wealth strategy, this is really all it's saying is, the tax law is really an instruction guide for building wealth and paying less tax. And paying less tax is a critical part, by the way, of building wealth. It's very difficult to build much wealth if you're paying a whole bunch of tax. It's really hard when you're giving that much money to the government.
Yeah. I mean, you start to see how much you're giving back when that could be invested, and the compounding effect of that. It's huge. It's huge. Can
I give you a simple math problem there?
I would love, well,
okay.
So I'm not very good at math. So as long
really
as it's super
simple.
easy.
Well, but this is recorded, right? So people can listen to this over and over again, right?
Okay. And I'm sure if I make any mistakes, everything will be edited.
Okay,
Go,
so
Tom.
here you go. So this is very simple. You take $10,000, invested at 10%, for 30 years. That's it. Just compounding every year for 30 years. And you pay 40% taxes on the income. Okay. So every year you make $1,000 on that $10,000, you're paying $400 of tax, right? 40% of your $1,000. After 30 years, you're going to have roughly $60,000. Not bad. Not bad. I mean, you went from $10,000 to $60,000. Most people go, that is fantastic. 6 times my initial investment. Going great. What if you paid zero tax on that income? After 30 years, that number is closer to $200,000.
Wow.
So it's like 3.5 times better to not pay tax than to pay tax. We're not talking about small incremental amounts here. We're talking about the velocity of compounding without tax. And that's where you really start building wealth.
Well, in the book, you talk about, like, I believe you say something about true after-tax returns to an investor. A lot of people don't really look at it that way, but like you just described it.
Yeah. I mean, consider also that a true after-tax returns includes the tax benefit of reducing your taxes somewhere else, right? It's not just, I'm not paying tax on that, but imagine if not only did you not pay the 40% on that $100,000 of income every year. But what if you actually got a tax benefit for the $10,000? Okay. So that you reduce your other taxes by $4,000 to begin with. And now instead of having $10,000 to invest, you have $14,000 to invest. Okay. Now the numbers get like stupid huge.
I was thinking, people listening might be thinking, I'm not getting any super practical tips. I don't understand how I can have my kids work for me and this, that, and the other. And I had the same frustration when I read Robert's book on, Rich Dad, Poor Dad. And he meant it as an accounting lesson for people. Yep. And there was a mindset shift. And I realized, like, if he would given me tactical stuff, it would not have been nearly as useful. And so I want people to understand, like, we're talking about things and we've talked about some tactical stuff, but if you could just wrap your mind around some of the bigger picture and the mindset things that we're talking about here, that's when you start to really understand that you might be playing a different game than you thought you were playing before.
Yeah, I would add, would you rather learn how to deduct a few things or how to deduct everything? As an example.
Everything.
Right. And everything, there literally is nothing that you buy that could not be deductible.
And if you think about it like that, you're asking your CPA different questions. You're asking yourself different questions. You're going to get different responses. Ask other people, search for the answers to those questions. Like it's amazing. It's amazing that we don't ask the right questions so often. And I started asking my CPA different questions. So when you said that, it struck a chord. I'm always asking them, how can I deduct this? I have a ranch. It's like a hobby ranch. So it's not a real ranch, but we get some great tax savings on just property taxes there.
Oh, sure.
I have property taxes because I have 41 acres versus 40 acres. That tax savings paid for that second 40 acre parcel that I bought. Like, that was a tax thing, not a I need 80 acres. But I'm like, holy cow, that's paid in spades for that. So yeah, I'm a huge fan of that. What else in your book, when you think about your book, what are some of the things that you're like, man, I wish these business owners understood this. They had this mindset. They would do this thing.
Well, I wish that they would combine strategies. So in other words, instead of just looking at business as your strategy, why don't you include real estate in your business strategy? Why don't you include energy in your real estate strategy? Why don't you include technology in your business strategy? All of these can be cumulative. And when I'll give you a simple example. I'll just give you me. Okay. So own a CPA firm. That's one of my businesses. I own the building that my CPA firm occupies. That's the real estate in that business. I'm putting solar panels on the real estate that houses my business. So now what I've done is I've got 3 different tax or actually wealth building and tax saving strategies that are combined together. That's where you really get some velocity and some power. On top of that, I have debt. So one of the great tax benefits in the world is debt. And people don't ever think about that one. I go into that in the win-win wealth strategy because people are either afraid of debt or they go, well, okay, I get an interest deduction. No. If I had $100,000 to invest and I just went out and say, I bought $100,000 of real estate, I'd get a deduction probably of about $20,000. But if I went out and borrowed $400,000 from the bank and buy $500,000 of real estate, I'd get $100,000 deduction. So would I rather have a $20,000 deduction or $100,000 deduction? And I'd get increased returns because, especially now where inflation is higher than interest rates, why would I not want to use debt? Well, the only reason I wouldn't is if I don't trust the asset in the first place. And if I don't trust the asset, why am I putting my hard-earned money into it anyway? So, to me, that's one of those little pieces of magic. And again, it's just, you look at these strategies. Eventually what you get to is the last chapter of the book which is how to get the government to pay for your Ferrari, which I know some of your people would love that, but this is a true story with real numbers of how one of my clients got the government to pay for his Ferrari through tax benefits.
How?
Well, that's the last chapter of the book. So
do you have to read the whole book, or can I just skip to the last chapter?
You can skip. I think most people will eat dessert first when they buy this book. I think most people will skip right to the Ferrari chapter, and then they'll go, okay, now I need to read the rest of it so that I learn how to do that.
I would imagine that this isn't just sensational of buy a Ferrari. There is takeaways that the average person can get from that strategy.
I'll tell you how big it is. So I teach a class to a bunch of entrepreneurs twice a year, in a particular profession, and the head of the organization, every time, and we teach this class together, he's the CEO of the organization. And he always asks me to show, how do you do this? How do you get the government to pay for your Porsche, Ferrari, whatever? He goes, because for him, that was the first time I went through that. And he was in the audience. He said that made such a big impact because it completely changes the way you look at wealth and the way you look at assets and the way you look at expense. Because this is not just how to get a Ferrari, it's how to get anything in your life. Right. So don't restrict that. I don't want a Ferrari. That's a very small-minded thought process, that. Right? Yep. Well, do you want a beach house? Do you want a legacy for your kids? Do you want to build wealth for your charity? I don't care what you want it for. This is the way to do it.
When you're talking about, I think about, hopefully minds are getting expanded and changed. You don't want to be the small-minded person. You need to expand your mind. Like as Tom was talking about, he put solar on his building. He didn't care everything that's going on in the news, that the green stuff and this, that, and the others. Doesn't matter. What matters is, it seems like the government wants to reward people that are doing green stuff. So I'm going to lean into that and stack that onto my already tax saving machine.
Yeah. So, okay. So you talk about tactics. Okay. So here's a tactic for you. Okay. Think about this one. That $100,000 of solar panels I put on my building, I will get a $26,000 tax credit, which is direct dollars back in my pocket. On top of that, because I put it on an office building instead of my home, I get an $87,000 deduction. Okay. Now, an $87,000 deduction in a 40% tax bracket is, I don't know exact math, but it's a lot of money. Okay. Effectively, I'm paying roughly a third of the cost of that solar, which means when I calculate my return on my investment, now it should save me about $7,000 a year. Okay. We've calculated this out with my solar guy. It'll save me about $7,000 a year. So you go, oh, that's a 7% return. That's okay. I'm going, yeah, no, it's not a 7% return. Multiply by 3 because I did not put $100,000 in. I put in a third of that. So you got to multiply that 7 by 3. Now it's a 21% return, and it's pretty much a risk-free 21% return, because I don't think we're ever going to see a year in Arizona where we don't have 300 days of sun. So I think I'm pretty comfortable the sun's going to come up in Arizona and it's going to blow hot every day, right? I'm pretty comfortable with that. It's like supposed to be 110 today. So all that sun all day long. And then I've got batteries on top of that. I'm going, wow, this is really going to have a huge impact. And I am an environmentalist. I mean, I think we do need to protect our environment. I think we do need to do more renewables. I'm a fan of that. So I look at it, I'm going, okay, so I'm reducing the amount of power that's coming from coal. At the same time, I'm building wealth because I've made my office building more valuable. I'm getting a 22% return on my investment and I'm paying zero tax. I'm going, I don't understand how any of this could be anything but amazing. I mean, I love this plan.
Talk about, I do too. And that's like just real life. And a lot of us business owners can do something very similar. It doesn't, we can do it on a massive scale or a smaller scale. Just think about that. I love this stuff. Okay. Tax deferral versus credit versus like, talk about that, because I've done a lot of tax deferral stuff. And then sometimes it comes back. I think it comes back to bite me. And, under
Here's
cost segs and things like that when you have to recapture it.
Okay. So here's book number 1, Tax-Free Wealth. Okay. Best-selling tax book ever. And it's, you look at look what it says. It says how to build massive wealth by permanently lowering your taxes. There's 6,000 pages roughly in the Internal Revenue Code in the United States. And of that 6,000, there's about 30 pages that actually raise revenue for the government. And the rest of it is basically an instruction guide to reducing your taxes. Of that 5,970 pages that is reducing your taxes, only 400 relates to deferral. So that means that you got roughly 5,600 pages that are focused on permanently reducing your taxes. So why are we messing around with deferral? In the win-win wealth strategy, the 7 investments, 1 is deferral. All the rest are permanent. All the rest are permanent. So I don't know about you. I prefer permanent to deferral. I'm a huge fan of permanent. Even in the deferral chapter, I go, well, okay, you want to invest in the stock market. It may work, but guess what? You do a lot better investing in business or real estate, and you don't ever have to pay the tax. So, you get to choose, but I'm not, deferring's okay because deferring is better than paying now, right? Because I want my money now, but never paying tax is way better.
Let's, whether it's a deferral or it's not paying, when do you see the tail wag the dog? When people are making bad decisions based on tax benefits versus the investment itself?
I give you the worst one, and I see this one all the time. I have somebody say, my CPA said I need to buy a new truck in December because otherwise I'm going to have a big tax bill. I'm going, do you need a new truck? No. So what's your tax rate? Well, 40%. So in other words, you're willing, let's say you go buy that $100,000,
Dude, they're $100,000 trucks. I'm about ready to buy a truck now.
$100,000 Raptor, right? And I've seen those Raptors can go get that high. So you're going to spend $60,000. You're going to pay $100,000 so you don't have to pay $40,000 in tax. I'm going, let me give you a better deal. Pay me. Here's the deal. Pay me $100,000 and you get the same tax benefit, and you get a $40,000 tax benefit, and you don't have to worry about whether it's, it's deductible or not. Cause I'm going to guarantee you that it's deductible but on top of that, I'm a way better investment than a truck. So my point is that don't let that tax tail wag the dog. I'm glad you bring that up because I do see it. Don't ever have the tax tail wagging the dog. You make sure that it's a wise investment first. Now, you say, somebody else comes to me and say, I'm thinking of buying a new truck. I'm trying to decide, do I buy it in November or do I buy it in January? I'm going, that's an easy one. Buy it in November. Or they'll say, I'm thinking of, I want this Ferrari. Do I buy it or do I lease it? I'm going, well, you get a much better tax benefit if you lease it. Well, but the lease cost is really high. I'm going, well, then don't lease it, right? The tax benefit's better to lease it, but you may be better off buying it. So always you look at the investment first and the tax second.
Robert came out and he started talking about debt a lot. And I'm sure he's gotten a lot of pushback from a lot of people. I'd love to get Robert and Kiyosaki and Dave Ramsey in a room and watch them have a good conversation.
I've been in that room before.
Tell me about it.
Oh my heavens. It's awesome. Here's what
I would imagine there's respect for each other. That's
very much so. Very much so. You know, Dave Ramsey's a good guy.
Mm-hmm.
The difference is Dave Ramsey's afraid of debt and Robert embraces debt, right? I believe if you look at it, if you're afraid of debt, it's because you don't trust the asset that is supposed to pay for the debt. If you trusted the asset, you wouldn't be worried about the debt. Robert trusts the asset. Dave Ramsey does not trust the asset. My question is, if you don't trust the asset, why are you putting your own money into it? I mean, you work hard for that money. I mean, most people, you know, the $100,000 that they need to put into that real estate investment, they worked really hard for that $100,000. They weren't like you, that, is barely working 1 day a week, right? Most of them actually had to do real hard labor for this. And I'm just going, well, why, if you don't trust the asset enough to use debt, why are you buying the asset at all? That's really my question. I think we need to challenge our assets much more frequently. And is it performing the way I want it to? Is it underperforming or is it non-performing? It's non-performing. I need to get rid of the asset. Okay. If it's underperforming, I need to increase the performance or get rid of the asset. So what I want is I would only want an asset that I'm comfortable using debt with.
Ooh,
if I'm not comfortable using,
you're only comfortable.
I would only want to buy an asset that I'm comfortable using debt with. If I'm not comfortable using debt with, I'm not comfortable putting my own money into it.
That's gold right there. Too many people, and Justin and I, we just had a fun podcast the other day, but we were talking about that. And so many people just want to swing for the home run versus being happy with singles, doubles, and triples and the occasional home run.
Well, I'm a national leaguer. I'm not an American leaguer. So I like those singles, doubles. I like the stealing home, right? That's my favorite play in all of sports is stealing home. Because I just think, small ball is fun. Small ball is fun. Billy ball's fun. I don't, the big home run hitters, that's great. But you remember, if you're a golfer, you drive for show and you putt for dough. And we just saw that with Cam Smith on last weekend, right? He won the British Open. He won the Open. And how'd he win it? He won it with his putter. McIlroy was killing it on his drives. And Smith's an okay driver, but he killed it. He absolutely won it with his putter. So, that's, putters, you're putting at 30 feet or 10 feet versus hitting at, 350 yards, right? With a driver, which one's more valuable? And we certainly saw that last week, that the putter is more valuable than the driver. So yeah, you still have to be, you need to be smart. And will you get a home run once in a while? Like you say, absolutely. But most of the time, I mean, if I look at my business activities, I look at my real estate activities, typically they're, I'd like them to be doubles and triples. I like staying away from the singles, but I'd rather have a single than strike out.
I love it. That is so good. That's gold. You guys need to check out Tom's new book, The Win-Win Wealth Strategy. Pick it up on Amazon. Tom, any last bits of wisdom, anything that you want to leave the audience with?
I would make a plea when you get the book on Amazon, leave a review, because this is actually, I think, a very important message for the world, because I do think there's a massive attack on entrepreneurs and investors going on in the world, particularly in our country. And this is a message we need to get out that, look, being wealthy and doing good and paying less tax, they're not mutually exclusive, right? You can be wealthy, you can make more money, you can pay less tax and do more good. And in fact, the more good you do, the less tax you'll pay.
Well said. Thanks for coming on.
Thank you.
Thanks for listening to this episode of the Franchise Secrets Podcast. Whether you're watching or listening, please make sure to subscribe to my YouTube channel and to whatever channel you're listening on. If you want my help with anything from buying a franchise to franchising your business, please visit franchisesecrets.com.